quickly. You have a real opportunity to make money if you short them, but it's not just the banks that will be hurt by the sovereign debt problems. The insurance sector is in big trouble too, because insurers hold just as much European government debt as banks.
Well, with so much uncertainty, Klaus, how can investors know for sure which stocks to short?
Again, it's difficult to determine which banks and insurers have the most exposure to the debt of individual European countries. So you have to diversify your shorts. That means using an inverse exchange-traded fund for the whole sector.
And that's exactly what we're going to be talking about with our next guest. Klaus Vogt from Berlin, thank you so much for joining us.
Thank you, Jamie. It was a pleasure.
The financial services sector represents the largest percentage of the stock market, so there are literally thousands of ways to invest. Now, some of the best bets in the banking sector may be exchange-traded funds, or ETFs. Joining us now with some recommendations is a top ETF expert, Ron Rowland. Ron, how can we sort through all the choices in this industry?
Like you said, Jamie, there's a huge number of investment vehicles in financial services. If you're looking for a simple, non-leveraged ETF in this industry, you have more than 30 different choices. If you want to get a bit more fancy with a leveraged or inverse fund, there are 7 more ETFs that would fit the bill. So you really have to know what you're doing.
Okay, Ron, let's say you think the banking sector is on the verge of another crisis. Which ETFs do you buy then?
Well, it depends on if you think the crisis will just decimate the regional banks or if you think it will become a full-blown collapse like we saw a couple years ago. If you think the regional banks will take the biggest hit, you'll want to buy ProShares Short KBW Regional Banking Fund. Its ticker symbol is KRS, and it's just what it sounds like. As the KBW Regional Banking Index goes down, this fund goes up.
Okay, what if you think the big banks like Citigroup and Bank of America are going to get caught up in this crisis, just like they did in the last one?
Well, in that case, you'll want to focus on the inverse ETFs that include the large banks. And there's several of those, and which one you buy depends on how much risk you want to take. There are ones that are not leveraged, such as the ProShares Short Financials Fund, and there's one that's leveraged 2 times. But the most aggressive and riskiest play is the Direction Daily Financial Bear 3X Fund, ticker symbol FAZ. Now, as its name implies, it's triple leveraged. So if financial stocks take a tumble, you stand to make a lot of money.
Ron, that's great for some of us looking to make a big splash, but what if I just want to protect my money from a downturn in the banking sector? What ETFs help me do just that?
Yeah, the best way to keep your principal safe is with short-term U.S. Treasuries. And there's a number of ETFs that allow you to buy those. One of the best is iShares Barclays Short-Term Treasury Fund, ticker symbol SHV. Now, that would protect you from a stock market correction or bear market, and you can buy it just like you would a regular stock.
Ron Rowland from the Lone Star State, thanks so much.
Well, thank you, Jamie.
Okay, we've told you how to protect yourself and perhaps even profit from a broad downturn in the financial sector. Coming up next, we'll get even more specific. Which banks are in good shape to survive another crisis and which are in danger of collapse? Melissa Gannon from Weiss Ratings will answer those questions in our picks and pans. And coming up later, Sean Broderick gives us common sense financial reforms that we need right now. All that and more when Money and Markets returns.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
Welcome back to Money and Markets. Once again, Jamie Holmes.
Global financial stocks may be headed for another major downturn. If that happens, thousands of banks, including some of the biggest, may be at risk of failure. Joining us to explain why and give us her picks and pads in the banking sector is Melissa Gannon. Hello, Melissa.
Hello.
She's the vice president of Weiss Ratings. Melissa, how are these banks still in trouble after the bailout?
Jamie, despite the bailout, many of the country's biggest banks still have a huge amount of toxic assets on their books. But it's not just the big banks. Already this year, we've seen more than 80 bank failures, more than double this time last year. And with the coming regulatory reform and continued loan deterioration, we're bound to see even more.
Okay, Melissa, can you give us some of the names of the banks that are in trouble?
Like I said, they're some of the biggest. Bank of America, Citibank, Wachovia, which was purchased by Wells Fargo, HSBC, and SunTrust all received a rating of D or lower, with Citibank and SunTrust getting D-minuses. All in all, there are 20 institutions with $25 billion or more in assets that we consider vulnerable.
Okay, what about the banks that are the strongest?
Well, unfortunately, that number is a lot smaller. Weiss Ratings found less than 1,000 institutions that merited a B+ rating or higher, meaning they're strong enough to be recommended to consumers. Whereas the vulnerable banks controlled about 44% of the industry's total assets, these strong banks control only 3.7%.
Of those, which is going to be the biggest?
While State Street Bank and Trust has more than $150 billion in assets and received a B+ rating, but it doesn't generally accept consumer deposits. Goldman Sachs is also on the list, but it accepts deposits mostly from brokerage customers. Among the consumer banks, Silicon Valley Bank, GE Capital Finance, and Sallie Mae Bank are all considered strong, with GE Capital even earning an A- rating. The problem is that those banks are far smaller.
Okay, so what's to say if those large institutions begin to fail, the government won't step in and bail them out again?
Right, nothing really. We're not saying these vulnerable banks will ultimately fail, although there's a risk if the economy goes into another recession. But regardless, we believe you should stay away from any institution rating D- or lower. That's because even if a bank is bailed out or taken over by the FDIC and then sold to another institution, consumers can miss out on promised interest income, lose access to lines of credit, or suffer other inconveniences. So investors should try to do business only with the banks that merit a rating of B+ or higher. You can get a free list of those banks by going to weissratings.com.
Okay, Melissa Gannon, thanks so much.
Thank you.
After the break, we're going to hear two opposing viewpoints on the need for financial reform. On one side, there's an argument for major changes that the government must make right now. On the other side, an institutional investor who says it's investors who bear the most responsibility for fixing the system. Money and Markets is back in a moment.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilis Mativ covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
Well, another banking downturn seems likely, and we've heard which financial institutions are well positioned to survive it. We've also heard why the regulatory overhaul in its current form is likely to fail. But that doesn't mean it can't be done. Joining us with some common sense solutions for Wall Street reform is Sean Broderick. Hello, Sean.
Hi, thanks for having me on.
Sean, what is the number one thing we can do right now to rein in some of these abuses in our financial system?
Well, Jamie, if we reinstated the Glass-Steagall Act, which separated commercial banking from investment banking, it would go a long way toward solving our problems. That was the law of the land for about 65 years. It was passed in the 1930s to prevent a recurrence of the 1929 market crash and the Great Depression. And it worked, but it was repealed. And as we saw in 1929 and again in 2008, when the same institution is both a bank and a broker, it leads to very bad things.
Wasn't it the Clinton administration that actually repealed Glass-Steagall, though?
Yes, it was. And the major players behind the repeal were Sandy Weill, then the head of Citicorp, and Republican Senator Phil Gramm. But Bill Clinton embraced the repeal. And according to PBS's Frontline, just days after the Treasury Department agreed to support the repeal, Clinton's Treasury Secretary, Robert Rubin, accepted an offer to become Sandy Weill's chief lieutenant at Citigroup. And this brings me to the second